August 6, 2011. Real Estate Capital Scoreboard August 2011. Chicago, Illinois, August 6, 2011. As the stock market hit news lows in the first week of this month, bond investors hardly fear the federal budget discussions and impending downgrades, helping keep mortgage rates low. Instead, low treasury yields are driven by global financial market concerns and a double-dip recession. In the past month, treasuries moved down to previous lower levels of the nearly a year ago, while floating rate pricing remains nearly unchanged. More recent concerns revolve around the fragile CMBS markets, as any savings in lower treasury costs are absorbed by higher swap spreads. Spreads widened more than 100 basis points as note buyers are nervous about the market recovery and quality of securitized mortgage instruments. Look for more volatility in this lending sector for the remainder of the year, as more mortgage bonds are issued based on stabilized pricing. During the past year, income property sales volume has increased by at least 25%, as investors step back into the buying arena. Institutional demand for trophy assets, mostly from REITs, in major markets skews pricing dynamics even as market conditions improve. Such investors will even consider paying above replacement cost in select fortress markets as extremely high prices drive new construction. Greater profits await investors willing to consider non-downtown areas. Capitalization rates dive below 5% for CBD assets and are about 200 to 300 basis points wider in outlying areas. In search of more yield, private buyers now reign in secondary markets. Multifamily rental increases go unabated with growth rates of 7% or more in select supply-constrained markets. Population demographics with a larger younger workforce, rising rental rates, falling vacancies, limited supply and low mortgage costs are the ideal conditions for continued profitability in this property sector, especially in stronger employment markets. However, nothing lasts forever. Investors should take note of improving home ownership conditions, supply threats and other forces on the horizon. Low-cost mortgage debt is fueling new apartment construction and the conversion of existing condominium inventory. Furthermore, unsold home inventory is about 3 times the normal levels, creating an extremely attractive ownership scenario not seen in years. Many housing markets are at rock-bottom prices and home ownership is now less costly than renting in numerous cities. Lastly, banks are starting to loosen consumer credit and mortgage pricing based on historically low interest rates, adding even more reasons to consider ownership versus renting. The Real Estate Capital Institute's director, Jean Peck, professes that we're clearly at, or near, the bottom of the housing market and at the top of the rental market. She adds, what goes up must come down, but the prospects are still very strong for owning core apartment assets.